A partnership is an arrangement where parties, known as partners, agree to cooperate to advance their mutual interests. The partners in a partnership may be individuals, businesses, interest-based organizations, schools, governments, or combinations. Organizations may partner together to increase the likelihood of each achieving the mission and to amplify the reach. A partnership may result in issuing and holding equity and may be only governed by a contract. Partnership agreements can be formed in the following areas. Business. Two or more companies join forces in a joint venture or a consortium to work on a project which would be too heavy or too risky for a single entity. E. Join forces to have a stronger position on the market. E. Comply with specific regulation. In this case, the alliance may be structured in a process comparable to a mergers and acquisitions transaction. Politics. In what is usually called an alliance, governments may partner to achieve the national interests, sometimes against allied governments holding contrary interests, as occurred during World War II and the Cold War. Knowledge. In education, accrediting agencies increasingly evaluate schools or universities by the level and quality of the partnerships with local or international peers and a variety of other entities across societal sectors. Individual. Some partnerships occur at personal levels, such as when two or more individuals agree to domicile together, while other partnerships are not only personal, but private, known only to the involved parties. Partnerships present the involved parties with complex negotiation and special challenges that must be navigated into agreement. Overarching goals, levels of give and take, areas of responsibility, lines of authority and succession, how success is evaluated and distributed, and often a variety of other factors must all be negotiated. Once agreement is reached, the partnership is typically enforceable by civil law, especially if well documented. Partners who wish to make their agreement affirmatively explicit and enforceable typically draw up articles of partnership. Trust and pragmatism are also essential, as it cannot be expected that everything can be written in the initial partnership agreement. Therefore, quality governance and clear communication are critical success factors in the long run. It is common for information about formally partnered entities to be made public, such as through press release, a newspaper ad, or public records laws. While industrial partnerships stand to amplify mutual interests and accelerate success, some collaboration may be considered ethically problematic. When a politician, for example, partners with a corporation to advance the latter's interest in exchange for some benefit, a conflict of interest results. Consequently, the public good may suffer. While technically legal in some jurisdictions, such practice is broadly viewed negatively or as corruption. Governmentally recognized partnerships may enjoy special benefits in tax policies. Among developed countries, for example, business partnerships are often favored over corporations in taxation policy, since dividend taxes only occur on profit before they are distributed to the partners. However, depending on the partnership structure and the jurisdiction in which it operates, owners of a partnership may be exposed to greater personal liability than they would as shareholders of a corporation. In such countries, partnerships are often regulated via antitrust laws, so as to inhibit monopolistic practices and foster free market competition. Enforcement of the laws, however, varies considerably. Domestic partnerships recognized by governments typically enjoy tax benefits as well. Common law. Under common law legal systems, the basic form of partnership is a general partnership, in which all partners manage the business and are personally liable for its debts. Two other forms which have developed in most countries are the limited partnership, in which certain limited partners relinquish their ability to manage the business in exchange for limited liability for the partnership's debts, and the limited liability partnership, in which all partners have some degree of limited liability. There are two types of partners. General partners have an obligation of strict liability to third parties injured by the partnership. General partners may have joint liability or joint and several liability depending upon circumstances. The liability of limited partners is limited to their investment in the partnership. A silent partner is one who still shares in the profits and losses of the business, but who is not involved in its management, and/or whose association with the business is not publicly known. These partners usually provide capital in the expectation of a return on their investment. Australia summarizing S. 5 of the Partnership Act 1958. For a partnership in Australia to exist, four main criteria must be satisfied. They are: valid agreement between the parties to carry on a business. This is defined in S. 3 as any trade, occupation or profession in common, meaning there must be some mutuality of rights, interests and obligations. View to profit, thus charitable organizations cannot be partnerships. Partners share profits and losses. A partnership is basically a settlement between two or more groups of firms in which profit and loss are equally divided. Bangladesh. In Bangladesh, the relevant law for regulating partnership is the Partnership Act 1932. A partnership is defined as the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. The law does not require written partnership agreement between the partners to form a partnership. A partnership does not also require to be registered. However, an unregistered partnership has a number of limitations regarding enforcing its rights in any court. A partnership is considered as a separate legal identity in Bangladesh only if the partnership is registered. There must be a minimum of 2 partners and maximum of 20 partners. Canada's statutory regulation of partnerships in Canada fall under provincial jurisdiction. A partnership is not a separate legal entity and partnership income is taxed at the rate of the partner receiving the income. It can be deemed to exist regardless of the intention of the partners. Common elements considered by courts in determining the existence of a partnership are that 2 or more legal persons are carrying on a business in common, with a view to profit. Hong Kong. A partnership in Hong Kong is a business entity formed by the Hong Kong Partnerships Ordinance, which defines a partnership as the relation between persons carrying on a business in common with a view of profit, and is not a joint stock company or an incorporated company. If the business entity registers with the Registrar of Companies, it takes the form of a limited partnership defined in the Limited Partnerships Ordinance. However, if this business entity fails to register with the Registrar of Companies, then it becomes a general partnership as a default. India. According to Section 4 of the Partnership Act of 1932, which applies in both India, partnership is defined as the relation between 2 or more persons who have agreed to share the profits of a business run by all or any one of them acting for all. This definition superseded the previous definition given in Section 239 of Indian Contract Act 1872 as partnership is the relation which subsists between persons who have agreed to combine the property, labor, skill in some business, and to share the profits thereof between them. The 1932 definition added the concept of mutual agency. The Indian partnerships have the following common characteristics. 1. A partnership firm is not a legal entity apart from the partners constituting it. It has limited identity for the purpose of tax law as per Section 4 of the Partnership Act of 1932. 2. Partnership is a concurrent subject. Contracts of partnerships are included in the entry No. 7 of List 3 of the Constitution of India. Government can legislate i.e. pass laws on 3. Unlimited liability. The major disadvantage of partnership is the unlimited liability of partners for the debts and liabilities of the firm. Any partner can bind the firm, and the firm is liable for all liabilities incurred by any firm on behalf of the firm. If property of partnership firm is insufficient to meet liabilities, personal property of any partner can be attached to pay the debts of the firm. 4. Partners are mutual agents. The business of firm can be carried on by all or any of them for all. Any partner has authority to bind the firm. Act of any one partner is binding on all the partners. Thus, each partner is agent of all the remaining partners. Hence, partners are mutual agents. Section 18 of the Partnership Act, 1932 says, subject to the provisions of this Act, a partner is the agent of the firm for the purpose of the business of the firm. 5. Oral or written agreements. The Partnership Act, 1932 nowhere mentions that the partnership agreement is to be in written or oral format. Thus, the general rule of the Contract Act applies that the contract can be in B, oral, or written, as long as it satisfies the basic conditions of being a contract, i.e., the agreement between partners is legally enforceable. A written agreement is advisable to establish existence of partnership and to prove rights and liabilities of each partner, as it is difficult to prove an oral agreement. 6. Number of partners is minimum 2 and maximum 50 in any kind of business activities. Since partnership is agreement, there must be minimum 2 partners. The Partnership Act does not put any restrictions on maximum number of partners. However, Section 464 of Companies Act 2013 and Rule 10 of Companies Rules 2014 prohibits partnership consisting of more than 50 for any businesses, unless it is registered as a company under Companies Act 2013 formed in pursuance of some other law. Some other law means companies and corporations formed via some other law passed by Parliament of India. 7. Mutual agency is the real test. The real test of partnership firm mutual agency set by the courts of India, i.e., whether a partner can bind the firm by his act, i.e., whether he can act as agent of all other partners. United Kingdom Limited Partnership. A limited partnership in the United Kingdom consists of one or more people called general partners, who are liable for all debts and obligations of the firm, and one or of the firm beyond the amount contributed. Limited partners may not draw out or receive back any part of the contributions to the partnership during its lifetime, or take part in the management of the business or have power to bind the firm. If they do, they become liable for all the debts and obligations of the firm up to the amount drawn out or received back or incurred while taking part in the management, as the case may be. United States. The federal government of the United States does not have specific statutory law governing the establishment of partnerships. Instead, each of the 50 states as well as the District of Columbia has its own statutes and common law that govern partnerships. These states largely follow general common law principles of partnerships, whether a general partnership, a limited partnership, or a limited liability partnership. In the absence of applicable federal law, the National Conference of Commissioners on Uniform State Laws has issued non-binding model laws in which to encourage the adoption of uniformity of partnership law into the states by the respective legislatures. This includes the Uniform Partnership Act and the Uniform Limited Partnership Act. Although the federal government does not have specific statutory law for establishing partnerships, it has an extensive and hyper-detailed statutory scheme for the taxation of partnerships in the Internal Revenue Code. The IRC is Title 26 of the United States Code, wherein Subchapter K of Chapter 1 creates tax consequences of such great scale and scope that it effectively serves as a federal statute statutory scheme for governing partnerships. History of partnerships. Partnerships have a long history. They were already in use in medieval times in Europe and in the Middle East. In Europe, the partnerships contributed to the commercial revolution which started in the 13th century. In the 15th century, the cities member of the Hanseatic League would mutually strengthen each other. A ship from Hamburg to Danzig would not only carry its own cargo but was also commissioned to transport freight for other members of the League. This practice not only saved time and money, but also constituted a first step toward partnership. This capacity to join forces in reciprocal services became a distinctive feature and a long-lasting success factor of the Hanseatic team spirit. A close examination of medieval trade in Europe shows that numerous significant credit-based trades were not bearing interest. Hence, pragmatism and common sense called for a fair compensation for the risk of lending money, and a compensation for the opportunity cost of lending money without using it for other fruitful purposes. In order to circumvent the usury laws edicted by the Church, other forms of reward were created, in particular through the widespread form of partnership called commenda, very popular with Italian merchant bankers. Florentine merchant banks were almost sure to make a positive return on their loans, but this would be before taking into account solvency risks. In the Middle East, the Qarad and Mudrabas institutions developed when trade with the Levant, namely the Ottoman Empire and the Muslim Near East, flourished, and when early trading companies, contracts, bills of exchange in long-distance international trade were established. After the fall of the Roman Empire, the Levant trade revived in the 10th to 11th centuries in Byzantine Italy. The Eastern and Western Mediterranean formed part of a single commercial civilization in the Middle Ages, and the two regions were economically interdependent through trade. Partner compensation. In certain partnerships of individuals, particularly law firms and accountancy firms, equity partners are distinguished from salaried partners. An equity partner is a part owner of the business, and is entitled to a proportion of the distributable profits of the partnership, while a salaried partner who is paid a salary but does not have any underlying ownership interest in the business and will not share in the distributions of the partnership, although they are both regarded as partners in legal and economic terms. Equity partners and salaried partners have little in common other than joint and several liability. The degree of control which each type of partner exerts over the partnership depends on the relevant partnership agreement. In the most basic form, equity partners enjoy a fixed share of the partnership. However, in more sophisticated partnerships, different models exist for determining either ownership or profit distribution. Two common forms are lockstep and eat-what-you-kill compensation. Lockstep involves new partners joining the partnership with a certain number of points. As time passes, they accrue additional points until they reach a set maximum, sometimes referred to as a plateau. The length of time it takes to reach the maximum is often used to describe the firm. Eat-what-you-kill is rarely, if ever, seen outside of law firms. The principle is simply that each partner receives a share of the partnership profits up to a certain amount, with any additional profits being distributed to the partner who was responsible for the origination of the work that generated the profits. British law firms tend to use the lockstep principle, whereas American firms are more accustomed to eat-what-you-kill. When British firm Clifford Chance merged with American firm Rogers and Amp Wells, many of the difficulties associated with that merger were blamed on the difficulties of merging a lockstep culture with an eat-what-you-kill culture.